we have Richard here, co-founder of a Silicon-based FinTech, investing in early-stage technology and life science companies. So actually, this will be a bit of a change of pace because everyone's kind of been pitching their products, and now you're going to tell us a little bit about what you're doing, Richard. So we're a small group, but we're mighty, so we're going to give Richard a big round of applause. Thank you so much, Richard. Give a round of applause right now. Here we go.
Well, good afternoon, everybody. Thank you very much for this opportunity to talk to you a bit about K2X. We are an investment firm focused on investing in early-stage companies, specifically seed Series A. We're structured to be publicly traded and in the form of an ETF-like vehicle. And what's attractive about this is we are very unique in that for any investor investing in us once we are public is to access quality early-stage companies, have liquidity, and reap the benefits of any sort of transactions that happen, more specifically by way of dividends. We decided to tap into this opportunity and created K2X largely for the reason that we have discovered that large angel groups and early-stage and sophisticated early-stage investors, when doing solid, rigorous due diligence, are able to achieve remarkable returns, probably far exceeding some of the more traditional risk investment out there. Hence, the formation of our company. Our mission, more specifically, is to create a liquid investment vehicle and allowing access to 99% of investors that normally wouldn't have access to high-quality early-stage deals. And to do so in a safe investment environment and in which to generate these potential returns. Now, there are some issues in this field, obviously, and it comes down to things like which companies to invest in. The issue about liquidity. As we all know, when we're investing in early stage, the horizons for an exit can be in the decade, and even more sometimes. And of course, the distraction of hot themes. Could be anything from AI, crypto, on and on, you name it. Oh, excuse me. What we've introduced is a solution, and that is creating a vehicle that identifies the quality companies, provides the liquidity to the investor, and more importantly, the diversity, whereby our basket of companies cover the spectrum of technologies, be them on the technology side, tech more simply, and on the other side, life science. And the criteria by and large being quality of the technology and quality of the deal. I think the way to best describe us is a statistical model. It's important to emphasize that we are not going full in as lead investor in every one of these deals. We go in as a minor investor and place many bets on many companies across a large basket of companies. The model is managed and steered by a number of very, very experienced angel investors to ultimately lead to a safer way to invest in early stage startups. This model, some criteria to consider in this model is that we don't lead deals. We reference a lead investor in any deal that we consider. And from there, we do our due diligence on the due diligence of the lead investor. That creates for what we term as double vetting. We are also agnostic to markets and to geography, meaning we'll go wherever the best deals are to be found, be them physically in another country or be them in any sector or any segment within the sectors of tech or in life sciences. As I referenced a few moments ago, the amounts that we invest are relatively small, ranging in between 50 and 250K. But we do expect that once we go public, that we will increase the size of those amounts. But it should also be noted that we also manage our portfolio very actively on a quarterly basis, and we do follow-ons with those companies and can reach up to $600,000 to $750,000 invested in any given company should they be performing and tracking to expectation. This all said, and the way I've described this, this model, is what we have here is a perpetual and evergreen investment vehicle. We are not a fund per se that is static with a number of companies and just see and manage the course of those companies. We are investing in a cycle basis to see companies come in, manage them through to an exit, take those funds, reinvest, cover some overhead, and then distribute any gains in excess to investors/shareholders by way of dividends. Just a quick overview here is the deal flow which we use. Nothing revelatory here, but essentially we manage our due diligence process by way of screening, the actual due diligence itself, going as deep as necessary subject to the gaps, making an investment decision by committees on a monthly basis, board approval, and then portfolio management, which incurs tracking performance of the company. As I mentioned, here's a better way to visualize this perpetual evergreen model. As you can see, we're putting money into new and follow-on companies, and as we're managing them through, we talk here of a horizon. In this slide, we say 5 to 7. Ideally, we like to see in 3 to 5 years, and generate those exits and deploy that capital. Our track record has been pretty good. We've raised over $17 million since we started, since 2018. We've made 170 investments in those 85 companies. We've achieved 3 exits, and we have 2 emerging unicorns in the bullpen and expected to exit within the next 12 months. One of the lows, of course, there has to be, especially in this line of investment. We have experienced 4 write-offs, or have had to do 4 write-offs, totaling just over $250,000. Our target, and what we are tracking so far, is an annual asset appreciation in the range of 20 to 30%. Some of the companies that have exited, we have Base Paws, which was acquired by the animal health division, the former animal health division of Pfizer, Zoetis. We have LTX, which was acquired by Accelerex, and Abfero by private pharmaceutical company. On the unicorn front, here are the 2 companies I was alluding to. Promaxo, which is developing and now commercializing an incredibly novel portable MRI machine system that is about the size of a bar fridge and is about to turn access to MRI on its ear, going from large bunkers in hospitals to being placed in physicians' offices. And that company is pegged, right now, the valuation is just over $400 million, and will rise to $750,000 with an imminent term sheet being signed off. On the other side, we have Neuroflow, another life science company, tech company, and we're currently seeing that company valued at just over $200 million, and on a very steady pace to double or more in the next raise in the next 6 to 12 months. Leading our organization is the founder, CEO, Paul Russo, a 50-year veteran in tech and startups, educated at Berkeley. He's been a senior executive in a few blue chip tech companies, founder and CEO of several startups, and a very, very active angel investor in multiple startup boards and engagement with large and respected angel groups such as Band of Angels, Keiretsu, and the Angel Capital Association. This can basically all summed up as extensive market transaction experience, both in the public and private space. Supporting Paul and moving forward this organization is a management team and a board of directors populated by deeply experienced professionals, well anchored in the early stage investment area. And to complete and most instrumental to the success of our model are the K2X advisors. In order to be able to manage our deal flow, to do the screening, to do the due diligence, we have a community or a pool of 100 advisors who are also investors in the company and are incentivized and motivated to see success in what we are doing. So our model's proven. We've raised the money, and we have achieved all of our objectives so far, and now we're moving to achieve liquidity in the form of launching a $50 million IPO, and that will involve a listing on NASDAQ in late 2024. Why I'm here is we need to bridge the gap, looking to raise some money between 5 and 10 million while we ready to launch ourselves on the NASDAQ market. And so our ask here is to invest in this debt note, which is actually a pretty good deal because we're offering interest of 9% on a cash basis or on an accrued basis at 12%. If the IPO shouldn't go forward by April 25, we will repay the loan with interest by April 25, and then that will be guaranteed by all the exit transactions that will occur with the 85 companies that are in the portfolio. That said, just to reinforce, we're introducing a better way to invest in startups, and it has to do with access to great startups, deep and rigorous due diligence, providing liquidity, and a much more efficient way of mobilizing capital from investors. And this is all translating into higher returns, lower risk, and non-correlated investment. That said, we encourage you to consider K2X and a great way to invest in pure innovation through a new asset class called angel stage startups. Thank you.
Thank you, Richard. So that was great. So obviously people want to find you other than, do you have a booth here or people just have?
Right out the door.
Okay.
To my right.
Okay, so just right out the door here to your right, you can come find Richard. So if you want to have more questions, want to get a little bit more into the conversation, he is available right here to have that conversation with you. All right, so how's everyone doing so far? Thank you, Richard. Give Richard one last round of applause. Thank you so much.